So now let's come to the story of the day. So Mr. S. Naren, who is a seasoned fund manager, has cautioned that if you basically he's saying that the risk is of the client, the consumer. It's your responsibility if you give us money in the mutual fund, and the company basically is taking no risk. You give us money at the top of the mid cap cycle, we will invest in mid cap because that's our um, that's the focus of our fund. But how the mid cap sector will do from there is not my sort of that's your risk. So there is, you can see it in both ways. Uh, he's a value guy. He probably he's unable to see value in most stocks, which is fair. Um, but then, as a fund manager, I don't know if you can really say that, that you're giving me money in mid cap, I'm applying it to mid cap, and I really can't help you. So discretionary funds, at least in my view, and whatever I'm saying is just my opinion. I'm not trying to pull anybody down. I have great respect for all the senior folks in the industry, but in my view, that statement is a bit, you know, sort of covering your own back, saying that I am not responsible. I mean, no fund manager can ever say that, in my view. Um, Especially the ones who are doing discretionary kind of business, because the fund is dependent upon you leading that fund to find the mandate that you have been given to find companies that you find value in, and so on and so forth. So the whole industry has kind of um, got divided on this commentary. There was a video that was posted uh, by the AMC. It was brought down. The commentary of the fund manager was changed. Some parts were left out, re-uploaded the commentary. So all that has created a lot of a trust issue, that if you are saying something and you've posted it online, then why are you pulling it down? And then the transcript of that is posted, and then it has changed from what you've said. I think all that is not really giving, at least me, a good feel about this all. So essentially what is happening in most asset management companies is that there is a sales team and there is the chief investment officer. The sales team is gunning for more and more AUM at whatever cost. They really would care less if you made money or not. They need to make commission. So the more you are able to sell, the more is expense ratio is what they're able to make. So sales has its task cut out. Now on the opposite side is the poor fund manager, and I'm saying poor because at some point of time, if the fund manager, especially of value kind, feels that there is no opportunity left in the market, then but the sales guys are still pushing in new AUM, new SIPs, then the guy has to invest. He could stay in some part in cash, perhaps some part in more defensive stocks. But at the end of the day, if the fund is a mid cap orientation, you will have to invest in mid caps. So everybody's trying to save their skin. The sales guy is saying, if I don't sell, I'll be out of job. The investment manager would say, if I don't show performance, I'll be out of the job. So it's a great sort of a vicious circle where the investor, the seller, the AMC sales, and the investment manager are trying to pass the buck. That investor is saying, I've given you money, now it's your responsibility. Sales is saying, I am selling, I'm getting the money, I'm pushing it to investment manager, so now you have to manage it. Investment manager is saying, I can't take this risk. This is the risk of the client. If you give me money at this stage, I'll just put it in the sector that you've told me to, but don't hold me responsible for it. Somewhat like that. So it is almost like there's a what do you call? It's a round robin kind of a that game children play, where you just pass the bucket. It's a hot potato in your hand, and you're saying, I don't want to hold it, you hold it. That's the kind of thing that is happening. And There is all kinds of anecdotes that have been given of the past, that if you started a SIP between so much time and so much time, it would be negative. If you started a SIP in mid caps in 2006, returns would have been negative. I think all this is known. There is nothing new that has been said, and every year cannot be a positive year. Every 5 years also cannot be all the time positive. There will be a time where market may go into a lull for half a decade. That's fine. Why I really don't know such senior folks why they are making this commentary that equity money can't be made in if you stayed on for this period. Why don't you combine that period with the huge kind of rush that happened between 1990 and 94? If somebody made 10x gains from 1990 to 1994 and they didn't do so well between 94 and 2002, so what? The whole game is that returns are always lumpy, and you can't expect any linear outcome from the market anyways. So I think the great job that the entire mutual fund industry has done in trying to galvanize folks into thinking about equity, these kind of statements are essentially marring that effort. um, but everybody has a right to their opinion, there's no issue about it, but having to moderate modify what they said and then remove and censor what you are saying, that you are not able to convince your sales guys, that is an internal thing. I mean, the AMC should uh, you know should not be doing this publicly, in my view. It really undermines their internal working of the team that is available there. So, I mean, full marks to Mr. Naren for bringing this out in the public. But I think the public needs to decide, uh, you know, uh, whether they have confidence on such teams where the internal fabric is so divergent in their view, and it is not something new that retail investors will come in at the top, most of them, and leave at the bottom. This is a global phenomena. It has been happening for hundreds and thousands, not thousands, hundreds of years. 1929 also happened, 1987 also happened, 2000 happened, 2008 happened, COVID happened. It is always the same. There are four animals in the market: bull, bear, sheep, and pig. Sheep and pig will get slaughtered always. People will get greedy always. They will get slaughtered. People will get fearful always, like they are getting now. They will also get slaughtered. So you have to become the bull and bear and not be the pig and sheep. That is all. You look at the last 100 years of data. The entire 100 years of data is telling you there can be lumpy returns in the market. If you're not learning from that data, and you're saying, okay, last 3 years I made great money, but last 1 year I didn't make money, and hence this is not the place to be. That is your own sort of inference out of it. Um, this is the Nifty Small Cap 100 Index. Just look at how it went up from 2004 to 2008, and then didn't do anything for the next 7 8 years. Does it mean that during that period, okay, small cap index did not make gains, but discretionary invested investing would have made a killing in this period? I mean, as this would have dropped, fund managers would have got a lot of opportunity in this period. Even when 2018 to 2020 drop came, it does not mean that somebody who was invested in 2018, those funds didn't make any money till 2022 or 2024. So this entire approach that from a point to point basis, you would have, if you bought here, then you would not have made money. Obviously, those instances will always be there. The question is that with 90% confidence or with 95% confidence, can you say that if you stayed in the market for 7 years, you didn't make money? No, that is not the case. Those outliers are being highlighted, that what if the same happens again. I mean, that will happen all the time. That's not new. And I'm so surprised that 4 months of a fall has so many and not just this current episode. So many people in the last 2 3 months are just trashing the entire story. I mean, you were talking about 10 years, 10 weeks ago, and now you're not even able to see the next year. So that is my sort of personal grudge against this, forecasting business. Yes, right now liquidity is moving out. Right now stocks are going down. If you choose, you can sit on the side, no problem. But the fact that most value guys are not able to appreciate is that five times more money, or you can say the supply of money has been created in the last 5 years out of thin air. So the metric that you were using 5 years back for valuing a company is no longer valid, in my opinion. If the base money has gone up five times, six times, I don't know how many times it has gone up, but it is somewhere near that order. How can you then justify that, okay, my price earnings ratio was so much, or my price to book was so much, or my EBITDA to so and so ratio was so much? Well, the base money has gone up. Where will it go? It will have to go and get invested, and you will have to figure out a new level of metric for evaluating the companies if you want to do that kind of investing. If one were to stick with the metrics used 20 years ago, even 12 times, 14 times price earnings used to be very, very expensive. Now you can't even buy there. In the last decade, there has been no case, even in COVID fall, that you reached in single digit or near 12 times price earning. So the paradigm shift is there in base money. You have to account for that in your equation, is my sort of stance. So my takeaway is that markets will continue to do this. This is the market way of sifting out strong players from weak players. The cycle and cyclicality will happen. If you can catch the cycles, very good. If you can't catch the cycle, follow strategies which will automatically follow those cycles. That is the key, because this whole discretionary business is where the the problem is, because once you are in a down cycle, your confidence is winning because you don't know the next up cycle when it will come. Of course, nobody can predict that. And will you be able to pick the winners on the next one? Which sectors will be running? Because it is so discretionary, and if you were good in the last cycle does not mean that you will perform well in the next cycle. So catching tops, catching bottoms, almost nearly impossible. Staying invested to different market phases, and not missing out on best performing period. There are so many studies which say that even if you step out of the market, and if you miss the best 20 days in a 10-year cycle, you probably are much behind a lot of other folks in the market. If those became the best performing days, you are out of the market, and tomorrow for some reason, for some news, some change of uh, you know plans of your country, the market hits a upper circuit, for instance, you are left out for the next 5 years now. So the easier way is to go the momentum way. Of course, I'm very confident on that. It there's a dynamic approach. Exits weak stocks, gets into more stronger stocks. Even if entire market is falling and we are also falling along with it, we're pretty sure that the next rally, whenever it happens, we will be able to ride those stocks as it comes out of the bottom, and that you have to wait for that. So your core principles should be clear. How you're going to select what to buy, when to buy, how much to buy, when to sell. All that has to be very, very clear. And once you know that your principles are crystal clear, then come any kind of market, you will sail through. So that is my take on this present discussion. I once again, I have no disrespect for any fund manager. Everybody has their own view, and but this discussion that has started because of Naren's take on the current situation, some of that I don't agree, and that's what I've illustrated in this video. I hope I'm sure you will have a lot of comments on this, so do write in your views. Thank you so much for watching, and I'll see you in the next one. Bye.